You have $50,000, maybe it's savings you've built up over years, maybe it's an inheritance, a bonus, the sale of something, or money you finally managed to set aside. However it got there, you're now facing one of the most common and most consequential questions in personal finance. Do you put it into real estate or into stocks? It's a debate people have fiercely, often based more on emotion and family history than on actual numbers. Your relatives might tell you real estate is the only real wealth. Online, you'll find just as many people swearing stocks are the only smart move. The truth is more interesting than either side admits, and the right answer depends on factors most people never stop to consider. By the end of this video, you'll understand the real returns of each, the hidden costs and risks nobody talks about, the situations where each one clearly wins, and a framework to decide exactly where your $50,000 should go. Let's break it down honestly. The headline numbers, historical returns. Let's start with the question everyone asks first. Which one makes more money? Over the long run, the US stock market has historically returned around 10% per year on average. Before inflation, after inflation, call it roughly 7% in real terms. That's the average of good years and terrible years blended together over many decades. Residential real estate, measured purely by home price appreciation, has historically returned around 4 to 5% per year on average. After inflation, that's closer to 1 to 2% in real terms. So if you're just comparing raw appreciation, stocks have historically won, and it isn't particularly close. $50,000 in the stock market, left alone for 30 years at a historical average, could grow to well over $800,000. The same $50,000 in home appreciation alone would grow to a fraction of that. But, and this is the crucial part, the comparison is incomplete and a little misleading, because real estate has a feature that stocks don't, and it changes the entire equation. That feature is leverage. The leverage factor, real estate's secret weapon. Here's where real estate gets interesting and where its defenders make their strongest case. When you buy stocks with $50,000, you own $50,000 of stocks. Simple, but when you buy real estate, you typically don't pay the full price in cash. You put your $50,000 down as a down payment and you borrow the rest. So with that same $50,000, you might control a property worth $250,000 or even more. This is leverage, and it dramatically changes your returns because your appreciation is calculated on the entire value of the property, not just the cash you put in. Let me show you what that means. Say you put $50,000 down on a $250,000 property and it appreciates 5% in a year. That's $12,500 of appreciation, but you only put in $50,000. So your return on your actual cash is 25%, not 5%. The borrowed money amplified your gain. That's the magic of real estate leverage. A modest 5% appreciation on the property becomes a 25% return on your money because you controlled a much larger asset with a small amount of cash. There's also a second hidden benefit. If it's a rental property, your tenants are effectively paying down your mortgage for you. Every month, part of their rent reduces your loan balance, building your equity without you spending a dollar. Over time, you end up owning an asset outright that someone else largely paid for. So when people say real estate built their wealth, this is usually what they mean. Not the appreciation alone, the leverage and the mortgage pay down working together. But leverage cuts both ways. Before you rush off to buy property, understand that leverage is a double-edged sword. It amplifies your gains, but it amplifies your losses just as powerfully. If that $250,000 property drops 5% in value, you don't lose 5% of your money. You lose $12,500, which is 25% of your $50,000, and you still owe the full mortgage. Leverage doesn't care which direction the market moves. It magnifies everything. This is why some people get wiped out in real estate downturns. They were highly leveraged, the market dropped, and suddenly they owed more than the property was worth while still being on the hook for the full loan. Leverage is powerful, but it adds real risk that owning stocks outright simply doesn't carry. So the real estate advantage isn't free. You're taking on debt, and debt is risk. The question is whether you can handle that risk and whether the property's income covers its costs even in bad times. The hidden costs of real estate nobody mentions. The appreciation numbers also leave out something huge: the enormous ongoing costs of owning property. These costs quietly eat into real estate returns in ways that stock investors never deal with. Property taxes, every year, often 1 to 2.5% of the property's value, forever. On a $250,000 property, that can be $3,000 to $6,000 a year, every year. Insurance, required and rising sharply in many areas, often a couple $1,000s a year or more, maintenance and repairs. The rule of thumb is 1 to 2% of the property's value annually. Roofs, HVAC systems, plumbing, appliances, they all fail eventually, and you pay for all of it. Some years it's nothing, some years it's a $12,000 surprise. Property management, if you don't want to handle tenants yourself, typically 8 to 10% of the rent. A vacancy. When a rental sits empty between tenants, you're paying the mortgage and all the costs with zero income coming in. Transaction costs. Buying involves closing costs of 2 to 5%. Selling involves agent commissions and fees of 5 to 6%. So just getting in and out of a property can cost you 10% or more of its value. When you add all of this up, real estate's true net return is often lower than the headline appreciation suggests. Leverage pushes it up, but these costs pull it back down. The honest picture is more balanced than either side of the debate likes to admit. The hidden advantages of stocks nobody mentions. Now, let's give stocks their fair hearing, because they have advantages that go beyond just higher average returns. Liquidity? This is enormous. If you own $50,000 of an index fund and you need the money, you can sell it and have cash in a couple of days. If you own a property and need money, you're looking at months to sell, thousands in transaction costs, and no guarantee of getting your price. Stocks give you flexibility that real estate simply cannot. Diversification? With $50,000 in a total market index fund, you own a piece of thousands of companies across every industry. If one company or even one whole sector struggles, you're protected by all the others. With $50,000 in a single property, all your money is tied to one building, in one neighborhood, in one city. If that local market declines or the neighborhood changes, your entire investment suffers. Zero maintenance and effort. Stocks don't call you at midnight about a broken pipe. There are no tenants, no repairs, no property taxes to chase, no management. You buy the index fund and you live your life. Real estate, especially rentals, is at least a part-time job. That effort has real value, and it's a cost people forget to count. Low fees and no debt required. You can start with any amount, pay almost nothing in fees with a good index fund, and you don't have to take on a loan to do it. The simplicity is a genuine advantage. Tax-advantaged accounts. You can hold stocks inside a Roth, IRA, or 401k and let them grow completely tax-free or tax-deferred. That's a powerful benefit that's harder to replicate with direct real estate. When real estate clearly wins, so let's get practical. There are real situations where putting your $50,000 into real estate is the smarter move. Real estate tends to win when you plan to hold for a long time, 10 years or more. So the appreciation and mortgage paydown have time to work, and the high transaction costs get spread thin. It wins when you can find a property where the rent comfortably covers the mortgage and all the costs with room to spare, generating positive cash flow from day one. It wins when you actually want to be involved, when you don't mind managing a property, handling tenants, or improving a home to increase its value. Some people enjoy this and are good at it. For them, real estate can produce returns that beat the market. It wins when you value the stability and control of owning a physical asset, and when you want the forced discipline of a mortgage that builds equity whether you feel like saving or not. And it can win in specific local markets where prices are low relative to rents, where the numbers simply work better than the national average suggests. When stocks clearly win. And here are the situations where stocks are the smarter home for your $50,000. Stocks tend to win when you want your money to grow, with as little effort and involvement as possible. If you don't want a second job, stocks are the obvious choice. They win when you value liquidity, when you might need access to the money or simply want the freedom to change your mind without massive costs. They win when you don't have enough for a strong real estate position in your area. In expensive markets, $50,000 might not even be a meaningful down payment, while in stocks it's a substantial, fully working investment from day one. They win when you want true diversification rather than concentrating everything into one property. And they win when you want to use tax-advantaged accounts to shelter your growth, which is one of the most powerful and underrated wealth-building tools available. For a lot of people, especially those who want simplicity, flexibility, and hands-off growth, stocks are the better default. Real estate is the better choice for those who want to be active and are willing to take on the work and the leverage. The option most people forget: you can do both. Here's something the all or nothing debate completely ignores. You don't have to choose just one, and there's a way to get real estate exposure without buying a physical property at all. It's called a REIT, a real estate investment trust. A REIT is a company that owns and operates income-producing real estate, apartment buildings, shopping centers, warehouses, data centers, and you can buy shares of it just like a stock. You get exposure to real estate returns and rental income with the liquidity, diversification, and low effort of stocks. No tenants, no repairs, no mortgage. You can even buy a REIT index fund that holds hundreds of real estate companies at once, inside your Roth IRA or brokerage account. So one perfectly reasonable approach with $50,000 is to split it. Put a portion into a broad stock index fund and a portion into a REIT index fund. Now, you've got the growth of the stock market and the real estate exposure many people want, all without becoming a landlord. For people who like the idea of real estate but don't want the work, this is often the best of both worlds. A framework to decide. So where should your $50,000 actually go? Here's a simple framework to think it through. Ask yourself 3 questions. First, do you want to be active or passive? If you want hands-off growth, lean stocks or REITs. If you genuinely want to manage property and are willing to do the work, real estate becomes viable. Second, how long is your timeline and might you need this money? If you may need it within several years or want flexibility, lean stocks for the liquidity. If it's truly long-term money you won't touch for a decade or more, both options open up. Third, do the numbers in your specific market actually work? Look at real estate prices versus rents in your area. In some markets, a property will easily cash flow, and real estate makes great sense. In expensive markets, $50,000 barely makes a dent, and stocks will likely serve you better. For most people who want simplicity and reliable long-term growth without a second job, a diversified stock portfolio, possibly with a slice of REITs for real estate exposure, is the strongest, lowest stress choice. For people who want to be hands-on, who found a property with strong numbers, and who can handle the risk of leverage, direct real estate can absolutely build serious wealth. There's no universally correct answer. There's only the right answer for your situation, your temperament, and your local market. The bottom line. Here's the bottom line on real estate versus stocks for your $50,000. Stocks offer higher average returns, total liquidity, effortless diversification, and zero maintenance, but no leverage and less control. Real estate offers the power of leverage and the discipline of a tangible asset someone else helps pay for, but with real costs, real risk, real effort, and far less flexibility. The wealthiest people often own both because they serve different purposes. But if you're choosing where to put $50,000 right now, be honest with yourself about how involved you want to be, how much risk you can handle, whether you'll need the money, and whether the numbers in your market actually work. And whatever you choose, the worst decision is to do nothing, to leave $50,000 sitting in a low-interest account losing value to inflation while you wait for certainty that never comes. Both stocks and real estate beat cash sitting idle over the long run. The most important move is to put that money to work. Pick the path that fits your life, commit to it, and let time do the heavy lifting. That's how $50,000 today becomes something far larger down the road. If this video helped you think through the decision more clearly, do me a favor and subscribe. Net Worth Nation is built for people who want honest answers about money, not one-sided hype, so they can make confident decisions for themselves. Drop a comment below. Where are you leaning with your money? Stocks, real estate, REITs, or a mix? And what's driving the decision for you? I read every single comment, and your questions often become future videos. If you know someone wrestling with this exact decision, share this video with them. A clear framework might be exactly what they need. And I'll see you in the next one. Let's build.